Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Markets never sleep. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Yesterday, PBoC unexpectedly cut its de facto policy rate by 10 bips. So here, I'm going to give you the details of this rate cut, and then we'll be discussing what policies we're likely to see in the near future, and finally, what it means for you, the investors. First of all, this rate cut is against market consensus, as DM central banks continue their aggressive rate hikes. This rate cut follows a set of much weaker than expected credit data last Friday, and very weak July real activity data yesterday, with retail sales growing by 2.7% in July year-on-year, well below the 5% growth forecast and down from 3.1% in June. Now, second part, what does this move mean for policies going forward? This is actually very significant. It's likely to be a key policy shift, suggesting more dovish PBoC policy in the months ahead to further stimulate China growth. There are two considerations here for the China authorities. One, how to revive growth, and two, assessing the risk of capital outflow. The first part on how to revive growth. Now, growth has been slow mainly because of weak demand. Firstly, in both credit demand by domestic corporates, and secondly, household demand for goods and services. So lowering rates rather than increasing liquidity supply is likely to be more effective in reviving demand. Now, on the second part, on the risk of capital outflow, this risk is now limited because this Fed policy may have passed its peak hawkishness. So thus, the authorities are likely to prefer lower rates and weaker CNY in the near term to further stimulate China growth. So finally, what does this mean for you, the investors? Now, there are three parts to this. First of all, for currencies. For dollar CNH, this probably means potential challenge to the upside of the trading range, i.e. the CNH to weaken further, with dollar CNH likely to be going to the resistance level at 6.8372. And this move by the PBoC is likely to hurt currencies that are most sensitive to Chinese growth, such as the Australian dollar, where it is currently testing support at 0.70. For bonds, it may alleviate some of the concerns, particularly those in the property space, given the government's commitment to stabilize the economy. Now finally, for equities, we continue to see the current weakness as a buying opportunity for Hong Kong China equities for those with staying power. Hong Kong China equities continue to be trading at 20% discount to global equities, and in our opinion, this recent underperformance from Asian or Hong Kong China equities has priced in, to a certain extent, the improving narrative in the US versus Asia, i.e. slowing inflation and still reasonable growth in the US. So that's all from me today. As always, if you enjoy this podcast, please do not forget to rate and like it. Thanks for listening, and we wish you a successful day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.